Have you ever noticed what's wrong with most free indicators that draw buy and sell arrows? They give you an entry point, but they don't explain the context at all. You see an arrow, you hit the button, and then the price just stalls. There's no follow through, no momentum. You just end up sitting in a position that goes nowhere. Why does this happen? Because traditional signals don't take into account the most important thing: the presence of liquidity. I'm Sokol, a trader and algorithm developer with over 5 years of experience. And today, I'm going to show you a tool that solves this problem completely. It's one of the most accurate open source indicators I've tested recently. What makes it unique? Standard tools for spotting reversals just mark highs and lows, hoping they'll act as levels. But this indicator works differently. It filters every extreme value through the volume profile. Let me explain. Imagine you have an analysis window, for example, the last 200 candles. Within this window, the indicator builds a moving volume profile, finds the point of control, the POC, the most active level, and only then checks if the identified extreme falls into a zone with truly significant volume. Only those levels where there was a real battle, not just a random price spike, make it onto the chart. Let's jump straight into practice. To add the indicator to your chart and trading view, go to the Indicators section, type Volume Profile plus Pivot Levels in the search bar, and add this indicator. I'll be demonstrating on the 1-hour chart of Bitcoin to USDT, but you can use it on anything: stocks, crypto, forex, and so on. After loading it, you'll see two key things. To the left on the chart, you'll see an interesting line appear. This is the very same volume profile. It shows how many contracts, or lots, were traded at each price level during the selected period. Inside the profile, there's a horizontal line, the point of control, or POC, which is the level with the highest volume. Now, pay attention to the color of the profile. It switches between turquoise and burgundy. It's not just for looks. The indicator calculates the delta. It takes the volume from bullish candles and subtracts the volume from bearish candles over the entire period. If the profile is colored turquoise, it means buyers are dominating. The bulls are in control of the market. If the color is burgundy, the sellers are in charge. The bears have the initiative. This gives you instant insight into which side the institutional flow is on right now. Next, let's look at the chart itself. You can see the horizontal dashed lines. These are the very filtered levels we've been talking about. And notice there aren't dozens of them. The indicator has filtered out all the noise. Each of these lines has passed a strict selection process. It had to fall within its price bin, meet the volume threshold, and have a volume no less than a certain percentage of the volume at the point of control. Next to each line, there's a compact tag showing two numbers: the absolute volume in that bin and the percentage relative to the POC, the point of control. For example, you see a level where the volume reached 85% of the maximum. This is no longer just a line. It's a zone of interest for major players. To squeeze the maximum accuracy out of the indicator, let's set it up correctly. Go to the settings. The first field is the period. This is the window over which the profile is built. By default, it's set to 200 candles. For most time frames, that's ideal. There's enough data, but no clutter or outdated information. But there are some nuances. If you're working on lower time frames, down to 5 minutes, you should reduce the period to 120 to 150, so the profile is more sensitive to recent changes. If you're looking at daily charts or higher, you can increase the window to 300 candles to see a stable long-term structure. The second important parameter is the resolution, or the number of bins. By default, it's set to 50. That's enough for good detail. If you want to see a finer structure, you can increase this parameter. Now let's move on to the most important part, the specific entry rules. I'll break down long and short entries step by step. For a perfect long entry, the first thing is confirmation of a bullish bias. Look at the color of the volume profile on the left. It should be turquoise. That's our main filter. If the profile's burgundy, we don't even consider long positions, because we'd be going against the flow of smart money. Second, look for a key support level. We need to find a volume confirmed low below the current price. In other words, a dashed line with a tag where the volume is, say, 40% or more of the POC, the point of control. Third, wait for a reaction. The price should first move up from this level, creating some room to maneuver. Then, when the price comes back and tests this level, we wait for a candle with a lower wick that pierces the line but closes above it. This is a signal that liquidity at this level has been protected. Fourth, enter the trade. We enter on the next candle after this wick. Set your stop loss below this low. Take profit either at 1.5 times your risk or at one of the confirmed resistance levels above. Let's look at the result. As we can see, this setup turned out to be profitable. The opposite situation applies for short positions. The volume profile should be colored burgundy. No longs, we're only looking for shorts. Next, we look for a confirmed high above the current price. The volume requirements are the same, 40% or higher. The higher the percentage, the more significant the barrier. Signal. The price dropped down, then came back up to retest this level. We wait for a candle with an upper wick that pierces the level but closes below it or right around it. This means that sellers didn't let the price go any higher. Entry. We enter on the next candle. Set your stop just above that high. Take profit of still 1.5 times the risk, or at the support level below. Take profit was reached, the trade was profitable. And the last important part is calibrating for the market. Different assets have their own rules, so you need to adjust the filter settings accordingly. Here are a few examples. Forex, default period's 200, and for the filter threshold, set volume as a POC percentage to 25 to 30%. Forex likes stability. These settings filter all the clutter. Cryptocurrencies, here it's faster and more chaotic. Set the period to 150 to 200 and lower the filter threshold to 15 to 20% since crypto volume is spread across many exchanges. Stocks, for swing trading by days, you can set it to 250 to 300. For intraday, 160. The standard filter threshold is 20%. Gold, this metal is very sensitive to big players. Set the period at 200, but I recommend raising the filter threshold to 35 to 40% to catch only the strongest moves from major levels. Friends, I hope this breakdown was helpful for you. The main thing you should take away from this video is that success comes not from the number of signals, but from their quality. When you combine structural levels with actual volume, you start to see the market through the eyes of the big players, not the crowd. See you in the next videos, and may your results always be positive.